Hello everybody, welcome back to ClearSurf Financial Education. I'm Carl Keister, and today's video is going to be discussing the options of paying down a mortgage early and which one is more beneficial to do. So I'm going to bring 4 different ideas here to you, and some of these have been talked about before, I'm sure, but I've seen a few videos out there that talk about some pretty crazy ideas on how to pay a mortgage off early. And I thought I'd bring you something that's much easier to follow and makes more sense, because quite frankly, using a high interest rate credit line I've seen some people talk about doesn't make any sense at all. Financially, the numbers just do not work. So anyway, I'm going to jump into it. But the first one I thought I'd talk about, it doesn't get a whole lot of play, to be honest with you, and that is switching to a bi-weekly payment. Now, what this does is it just forces you to pay your mortgage every 2 weeks. So whatever your mortgage payment was, if it's $954, you just pay the $477 every 2 weeks. And what that does is, because you're paying every 2 weeks, just like a lot of people get paychecks deposited into their account every 2 weeks, when you pay your mortgage every 2 weeks, you end up making an additional payment. So you're making 13 payments per year on your mortgage instead of 12. Now that's beneficial in the long term, because you do end up saving quite a bit of money on interest. And so it does allow you to come up with that extra payment. So rather than trying to look around which account I can take money from, or is there extra money in the savings or checking to make that extra payment each year, if you're not as disciplined, is you can set up this bi-weekly pay. So one of the examples I'm looking at here, if you had a 30-year mortgage, at a $200,000 balance and a 4% interest rate, by making a bi-weekly payment, I've done the calculator online, and there are plenty of calculators out there to use. Some of you have to look for it. It says specifically for a bi-weekly payment calculator. Make sure you use that. But in this example, you would save $22,553 in interest just by switching to a bi-weekly payment. So you don't have to always think about going out and refinancing or look at shopping around for rates and what the closing costs are going to be. But there's something you do want to consider, and that is, when you set this up, some banks won't do this. Some banks will not allow you to go to a bi-weekly pay. Other banks will charge you a fee to do that. So you want to make sure that the fee that they're charging you to set up a bi-weekly pay does not cost you more than the benefit of doing this. And also, one thing to keep in mind too is it may be difficult to stop. So if you set this up on a bi-weekly pay, and let's say you're not a salary individual, let's say you're hourly and your hours get cut, which a lot of people have during COVID-19, then it's going to be hard to contact the bank, and it could be a process to get that to stop taking out that bi-weekly pay. So you want to keep that in mind. So that's one thing that doesn't get talked about a lot, is bi-weekly pay. Now, the next thing to do is just make extra payments. Just common sense. You can go on there, but one thing you want to make sure is when you go on there on your payment online, there's a line item that says principal or interest. Make sure you apply it towards principal. Because if you don't apply it towards principal, it may not end up going towards that. It may not save you any money. Even small amounts of extra money towards this can help. So let's say you've been going out to lunch 3 times a week. Maybe go out once a week or not at all. And if you apply that extra money, that can literally save you tens of thousands of dollars over the cost of your mortgage over the period of 20 or 30 years. So just keep that in mind. And the other thing you want to think about is any bonuses. So some folks get a bonus or a pay raise. Some people would actually put that extra money into a retirement account, and other people would say, you know what, I'd rather be debt-free. It depends on your mindset and what you think. Now again, rates are historically low right now, so it does make sense that you may want to put that into a retirement account. If you think you can get more than 4%, then that might be something to think about. Now the other thing I want to bring up to you right now before I forget about it is, if you've got high interest rate credit cards, you want to pay down those credit cards first before you start worrying about putting extra money or bi-weekly pay on a mortgage. Current rates I just did some research yesterday and found 15-year mortgage around 2%. That is unbelievably cheap. So if we're talking 2 to 4% interest rate environment, definitely pay down those credit cards first. Any outstanding lines of credit, anything that's more than your 4% mortgage, you want to pay those down first. Now the other thing you could do, and this is the number 4 item, is consider refinancing to a shorter duration. So if you have a 30-year mortgage, you want to refinance to a 25 or 20-year, potentially a 15-year. But I brought this one up last, and the reason being is that there generally are costs involved with refinancing. So there's origination fees or points, and even if you get a 0-point loan, you won't get the best rate, but you're still going to be paying closing costs and doc fees and things like that. So I brought this one up last because, quite frankly, you're going to have to lay out more money, and you need to weigh that. I mean, this is something that we did just 3 years ago. Went from a 30-year mortgage, we were 3 years into it, and went down to a 20-year mortgage. So that shaved off tens of thousands of dollars in interest, and honestly, considering doing it again down to a 15, but now I'm sitting here myself weighing, just want to pay extra, or do you want to refinance where there might be some cost involved and drop it down to another loan? So right now at this point, it almost seems like rates have gotten so cheap, but at the same point, I can get there. And I'm going to actually bring this up in the video here. I'm going to go into my computer and do a screenshot here and show you the differences. I bank with a bank that actually allows you to see what it does if you pay extra payment, if you do a bi-weekly payment, or if you put down a lump sum. That's something we didn't talk about yet either, just putting down a lump sum to reduce your interest. And it's pretty interesting to see how much money it takes with like a $10,000 or $11,000 lump sum versus going bi-weekly versus paying an extra $150 a month roughly, let's say. It was pretty interesting to me to see how much it took to get to the same point, but you've got flexibilities there. You're not, like I said earlier, if your hours get cut back, you're not forced to keep that bi-weekly pay. If you give up that lump sum and you lose your job or your hours cut, you might regret putting that lump sum down your mortgage. Where if you're just consistent, pay extra each month that you have it, put everything you can towards it, you keep control of the flexibility, you keep the interest rate low, and that seems to be pretty reasonable. So in summary, should you pay off your mortgage early? Well, it depends. Like I said earlier, if you've got credit card debts, you want to pay those off first. Do you have an emergency fund established? You really should have 3 to 6 months of emergency fund sitting somewhere, so if you do lose a job or hours, you can cover your bills until you can find some other way to make a living. So also we talked about the investment account. So if your mortgage is 4% and the stock market is returning, since the depression has turned closer to 10%, this current year market's doing much better than that, especially if you're involved in any kind of tech stocks. So that's something to consider. And also one of the big things too is if you're going to move, you don't want to refinance something that may cost you thousands of dollars, and you can figure it out. They'll tell you, or you can easily figure out one of these calculators that basically it may take you 3 to 5 years to recoup your costs for refinancing, which is why we did it. And now you're at the point where like every month on you're saving money. But you want to be certain that you're going to be in your home before you do a refinance, because you might be better off just to pay the extra payments and not incur any costs. And that way, if you want to sell your home, you've been there for a few years, it doesn't really cost you anything. So, and then the last thing I'll mention too is the tax code. This is something that's changed where the current tax code, ever since the Tax Cut and Jobs Act went into place under President Trump, it really does not reward you for being a homeowner. You used to be able to claim your mortgage interest, property tax, contributions, and healthcare or other things if it was over a certain threshold. But now that the standard deduction for a married filing joint is approaching $25,000, single 12,400, somewhere 500 in that ballpark. Now that we're approaching those numbers, I saw fewer and fewer of my clients last year who could even itemize, and we haven't itemized in years because we don't have that much mortgage interest, property tax to get us past $25,000, thankfully. So that's another thing. We're really not being incentivized for these large mortgages. So paying it down, great, but at the same token, if you can take a car payment or a high interest rate credit card and you can kind of roll it into a mortgage that's 4%, well, that makes a lot more sense to me, to have all your debt at the lowest interest rate possible, and then you're getting some benefit because now we know that it looks like Joe Biden is the president-elect. If he gets into office, and he talked about rolling back all these Tax Cut and Job Acts, so that could be one of the things that get rolled back. And then again, holding a mortgage might be beneficial. Only time is going to tell, but we'll see. We're going to find out here very shortly. Matter of fact, probably by January 20th, when the inauguration is supposed to take place. I would hope by then we'd have certain that there was either going to be, we know who the president's going to be, and maybe have a glimpse. It probably won't affect us for 2021, but if there is a new administration, or the administration stays the same, either way, we should know what the tax code is going to be, so we'll know whether holding a mortgage is worthwhile. So either way, but I just want to bring those options to you, and I do think I'm going to jump into the screen here, and I'm going to show you some options for what I found, or the online calculators that show this to you. So, all right, until next time, see you then. I'm going to show you this calculator. This is Chase Bank, and just give you an idea. This is the box 3 here is a flex. They call it flexible payments. It's a biweekly pay basically. You pay every 2 weeks, and it would shave. Of this example, shaves $9,366 in 2 1/3 year, or 2 1/4 year off the mortgage. If you did a lump sum, you need to put $11,000 down to get the same interest savings, although you do have to pay the mortgage a little bit longer by using the lump sum method. And then the box 1 here shows you, I just pulled the calculator here, you can see that it varies, but 134 is the number that gets me closest to the biweekly pay, which is $93.88 in savings, shaving 2 years and 3 months off there. So I'm sure there's other banks out there that have this kind of software as well. I just want to show you, this is Chase. So this gives me an option of what I want to do. So when I'm in here, when I'm playing with these numbers, I can kind of see what I want to do and what kind of additional funds I need to put down if I want to hit savings. So if I want to save $10,000 on my mortgage, obviously I just need to slide this up until I get to that number. So right there, you can see it's about 145, let's call it. So 145 a month will get me $10,000 in savings, additional payment of 145 a month. And obviously, if you got a little extra cash, say you want to do $200 a month extra, then we'll slide it up here, and you can see that's going to save over $13,000 and shave 3 years off the mortgage. So that's why I said you really need to compare if you want to refinance, because there's cost involved, where you go with the additional payment, a lump sum, or the flex plan. So just want to let you know there's software out there. So anyway, please hit the like and subscribe if you haven't already, and hit the notification bell so each time I put out a video, bring this great content, and we'll see you on the next one. Take care.